Welcome back to Market on Close. I'm Oliver Renick. Let's talk some energy. Scott Bauer is with us, the CEO of Prosper Trading Academy. Scott, good to see you. Let's talk a little oil. It hasn't bounced back in really any demonstrable way. We've had a few days of strength. We've had a couple, I would think, somewhat bullish inventory reports in terms of draws, but what's going on?
You know, it's a sell-first mentality, which is just quite the flip-flop of where we were 6 weeks or 8 weeks ago, where, you know, every kind of drawdown, every sell-off was met with buyers. And now there just can't be enough sellers with their finger on the hot button selling right now. Yeah.
Now, we got a draw that we saw, I mean, on the 6th here that was just massive, right? You and I talked about this, I believe, for crude at least. Now, your point is, look, this stuff may not be taking front and center right now. But I thought the other stuff, the sentiment, the OPEC thing and all that, I thought we got that done too.
Well, you know, that's behind us because last time we talked, that was, you know, still yet to be determined.
Right.
But the more and more that we hear economically about growth, economic growth slowing across the world, the more pressure it's putting on the oil space, the more pressure that every rally that we're seeing right now is being hit with sellers. And you know, continual news keeps coming out that is increasing the headwinds facing oil space right now. You know, look at what OPEC just said. They had to trim back their forecast another 100,000 from where they just had already trimmed back. In fact, the U.S., which is now an exporter, you know, just for the last short while now, actually exported in this last report less than expected. So every metric that we're seeing come out now is negative, even with that big number that we saw last week, that unexpected number that we saw.
Yeah. Scott, this is interesting because on the way down, it was a very supply-driven discussion. It was the OPEC stuff. Yep. It was the tweets. It was the reserves. It was everything that eventually, I think now in the past 10 days, especially as the stock market has started to sold off cyclical companies, then now we're thinking, you know what, there might actually be a demand component here too. And it makes sense because on the way down we discussed this as well, right? How much of this might actually just be the similar type of risk-off nature that's going on across asset classes. So do you see similarities between the stock volatility, the crude volatility, the yield curve compressing? I mean, this is, you know, there's a lot of signs that these things go together right now.
No question about it, Oliver. And again, no matter what asset class you're looking at, again, whether it's treasuries, whether it's interest rates, yields, energy, the overall stock market, S&P, it's a sell-first mentality right now. So you get some tweet, you get some headline news, another piece of headline risk here, and the first button across all space is sell right now. And that's no different than what we're seeing in the oil space right now.
Yeah. Scott, what happens then? Or let me ask it this way. Is there a risk in the market to economic strength? If we get some surprise, or are we just basically, you know, not even guessing about an inflation beat? Do we just assume that, look, inflation's not going to be there? This is the read through. We have to look for something else to measure our economy.
You know, I am the ultimate contrarian when it comes to risk headlines and when it comes to news-driven events that drive a certain sector in a certain direction. And I'm no different right now with what's happening here. I think this fall has been way too fast, too far, and that the potential reversal is there. If we start seeing the economy pick up again, and we start seeing all the pundits out there and all the experts out there saying, you know, maybe demand isn't slowing as much as we anticipate it to be, we could see a spike up in oil. Now, I don't see that happening anytime in the near future, meaning the next probably 60 to 90 days or so. But as things unravel, as the Fed probably pulls the reins in a little bit, the market likes that, and maybe the market gets a little bit of traction to it, you may see a lot of short covering in the oil space probably in the first couple weeks of the new year.
So that's interesting, because if what we just discussed is true, that there is an economic concern that's weighing cross asset class, if it has an impact on oil to lift if something changes, where else? Do we also think this then applies logically to stocks, or do you have this kind of risk where, oh, if we get some big beat on the data, then maybe the FANG stuff that's up today is going to go right back down because then people are worried about valuations?
No, I do think you'll see it in the overall stock market, the broader market. I'm not saying it's going to be in the FANGs or techs or
Sure.
in consumer cyclicals, but I do think that you'll see it because, again, right now there's so much uncertainty. The market does not like uncertainty. And quite frankly, investors, retail analysts, no one really knows where this market's going to go. And we see changes on a daily basis about outlook. So I do think that the overall market can rally if we start to really get some solid footing, some solid gains out of some of the economic numbers again, maybe a little bit hotter of a read, and especially after next week when the Fed comes out and if they take that next step and really say, you know what, we're going to pull the reins in a little bit. Now we're looking maybe 1 to 2 hikes in 2019, if that, as opposed to the 2, 3, or 4 potential hikes.
Yeah. All right, Scott, great stuff as always. A little cross asset beginning with oil there. Thank you, Mr. Bauer.